But I do want to start with you on the US debt limit, because this is something where we're out of the clear on the surface, but you have been very, very clear. You recently revived a presentation you did 10 years ago with students at USC, and you've told them that the economic storm that's brewing from US spending is worse than you had imagined. I also want to bring up on the screen some of the charts that you showed them, kind of the pace of entitlement spending in the United States. I want to ask you, what are the consequences now that we're kind of past the initial pains in Washington? What is the country and the economy and investors, what are they ignoring?
Thanks, Sonali. Nice to be here. I don't think the entitlement situation is something you should be trading on in the next 3 to 6 months. What I've been focused on actually for over a decade is the long-term picture and the long-term implications. So the last thing you should do is run out of this conference after I say something about entitlements and think there's a trade to be made on it. That's not the situation. Look, I need to go back a little bit, but way back in the 90s, somebody sent me a paper outlining how the birth rate in the 50s was so high and it had shrunk, and that we're going to have this demographic storm hit sometime in the 2020s. And you could pretty much map it because the demographics are public information. This was on top of the fact that since Medicare and Medicaid joined Social Security as entitlements in the 60s, the senior share of government spending had already grown dramatically, say from 30 to 58% of outlays during that time. And I was concerned way back then that sometime in the 2020s, sort of like the pig and the python, when the baby boomers became seniors, already with them a high percentage of government spending, your growth of seniors would be dramatic, and by the time I was looking at it, the birth rate for the current generation was below 2, so you're going to have this huge increase in seniors at the same time that you had a reduction in workers. And the way our system works, you take the taxes of current workers to pay for seniors. It really looked bad to me in around 2011 or 2012, so much so that I thought I'd go out and see if I could move the needle on this issue. I was really successful. The only thing Donald Trump and Hillary Clinton agreed on was that you shouldn't touch entitlements. In other words, nobody listened to me. It was a tough situation then, and looking out, it was really scary. But when you just use the term worse than I ever imagined, what I didn't know is the next 10 years, we were just going to have a proliferation of government debt, even outside of entitlements. And then when COVID hit, it was just sort of the cherry on top. It's hard to believe, looking back during those 10 years with interest rates near zero, you had 2 big economic booms, one going into 18 under Donald Trump, supposedly a Republican, supposedly with a party that cared a lot about spending. And with 3.5% unemployment, we had something unprecedented. We had a $1 trillion deficit. Usually when the economy is roaring, tax revenues go up and the deficit shrinks. We then had a post-COVID boom in 2021, which was also accompanied by wild increases in tech and in tech stock prices, so much so that we had capital gains $600 billion above the average capital gains for a year. We sold $100 billion in spectrum sales. We had 10% nominal growth because of inflation. So you might ask yourself, since the last tech boom in '99, under a Democratic administration, by the way, we had a surplus. How big was the surplus with all these anomalies in 21? Again, I've led my own question. We had over $1 trillion deficit. We didn't even get to less than 5% of GDP. So what I was worried about 10 years ago, you now have an enormous amount of debt on top of it. The zero interest rates kind of suppressed what I would say is the concern about this. Obviously, if you have a lot of debt, you're not paying any interest on it, who cares? But now once the inflation hit, interest rates are going to go up. So the punchline, I'm rambling on here more than I wanted to. The punchline is, if you take the current situation and you ask yourself, well, I should actually say something else. The debt went from, say, 20 trillion to 15 trillion to 31 trillion over that time. That debt, and this is important because most people don't understand it, assumes there'll never be another Medicare or Social Security payment made. That's
200 trillion is the present value as you've calculated for the students.
Not me, credible people, Larry Kotlikoff and others. So if you assume we're never going to have another Social Security or Medicare payment, the debt is 31 trillion. But if you did your accounting like any corporation and you assume those payments are going to be made, yeah, the present value is probably around $200 trillion.
So, I should also say that the big title of this presentation is U.S. exceptionalism at risk. Is it?
Yeah, I think it is. America is an amazing country with an amazing system, and if you look at the innovation in this country, just look at what's happened since 1980. We led in the PC revolution. We led the development of the internet. We led the development of cloud. We led the development of mobile. Maybe it's not good that we led in crypto, who knows? And we're obviously leading in generative AI. So we've been the leader throughout, but we've also been the reserve currency. And we've been eating so much seed corn presently that I worry about the future. If you were to take, economists have this, only economists could come up with this term, it's called fiscal gap. What is fiscal gap? That's how much you would have to raise taxes today to guarantee the benefits you promised seniors in the future. It's 7.7% of GDP. What does 7.7% of GDP mean? To actually pay for the entitlements we promised in the future, you'd have to raise all taxes 40% today, forever, or cut all spending 36% today, forever. So what I'm looking at here is this stuff is borrowing from the future. You're going to crowd out private investment. You're going to crowd out the kind of investment that made us a leader on all those kind of things. But again, this is a long-term worry. But the statement by both parties that entitlements are off the table, it's like 70% of the federal budget and rising. And now that interest rates have come up, it's a fantasy. In fact, it's a lie. We are definitely going to cut entitlements. It's just a matter of we're going to cut them today or in the future. And the longer we wait, the more it piles up. A year or two ago, or right now, the interest expense is about 1 or 2% of GDP. It's about 6% of outlays. The CBO's estimate, not mine, interest expense is 27% of outlays by 2050. And just entitlements and interest expense, just those two things alone, no defense, no running the government, no money for the disadvantaged, will be 117% of taxes by 2050, and it'll be more than all taxes by 2040. But again, for investors in the room, this is just stuff to worry about in the long term. I like to think in the long term, but for trading, it doesn't impact your original question.
Well, the way you put it to the students, it's the tsunami that is 10 foot out on the horizon. But